Hugh Chung. I'm the Chief Investment Advisory Officer at Endowus. I'll introduce myself a bit later. I'm so glad that we have our esteemed guest, Chris Antonelli, who's Managing Director and Co-Head of Asia for Schonfeld, as well as Mandy, who's Head of Capital APAC for UBS. Maybe Chris and Mandy, you can briefly introduce yourself.
Hi everyone. I'm very happy to be here. Thank you, Endowus, for inviting. So my name is Mandy, and I am with UBS. I've been with UBS for about 6 years now. I head the capital introductions team over there on the global markets and prime brokerage. So for those who might not be familiar, we help our clients hedge fund make introductions to investment hedge funds. And we are a very global team of about 25 people across APAC, Europe, as well as US. Prior to UBS, I have been an allocator to hedge funds for the French bank. I've done that for over 12 years and have done that primarily out of New York as well as Paris. So that's my background.
Thanks, Mandy. And Hugh, also like to say thank you for inviting us to speak tonight. And Mandy, great to be in the panel with you once again as well. Thank you to all of you for joining us here tonight. As for an introduction on myself, my name is Chris Antonelli. As Hugh had mentioned, I'm the co-head of Schonfeld Strategic Advisors here in Hong Kong. I've been with the firm for approximately 5 years. Prior to that, I spent 20 years on the sell side. You might be able to tell from my accent I'm American, so I started my career in the States working for Lehman Brothers. So I spent 10 years at Lehman Brothers in New York. I spent some time in Tokyo with Lehman Brothers, and there was a thing called the Lehman bankruptcy. Ultimately joined Nomura in Asia in Tokyo, and then Nomura in Hong Kong. I was ultimately running the global prime brokerage business, overseeing our hedge fund clients, of which Schonfeld was a part of that complex. And as I said, 5 years ago, I joined Schonfeld to oversee the Asia APAC region. A lot of my responsibilities focus on the non-investment side of the business, or the day-to-day operation of the business, working very closely with our investment teams and the head of our fundamental equity business development side.
Thank you, Chris. So just an intro of myself. I joined Endowus about a year ago. Before that, I was working for a family office, allocating to hedge funds. I started my career in the sell side, giving ideas to hedge funds, and then I joined 3 hedge funds. And then later on, right now, I am curating and distributing hedge funds. So hedge funds have been a very important part of my 22-year career, and I'm excited to talk about hedge funds with very, very experienced senior professionals. Today's subject will mainly focus on multi-strategy hedge funds, which have been really at the core of a lot of growth seen within hedge funds. And clearly Schonfeld is one of the leading players there. Mandy will have a lot of insight on capital flows going into hedge funds as well. But before that, I just wanted to give you a brief update of Endowus for those of us who are not familiar with the platform. I know some of you are already clients, so I'll be very brief. The usual disclaimers here. So we are a conflict-free wealth management platform. And what that means is that we only get, our clients are the only ones who pay us. So we don't get any rebate or any fee from the actual fund managers themselves, which is a common practice for a lot of other distributors in Asia. So we want to make sure that the products that we onboard onto our platform is driven by our own independent analysis of the product and not by any different motivation. And so we provide institutional access to individuals at low fair fees. So as you can see below, our biggest shareholder of Endowus are the employees, ourselves, but our external shareholders include UBS, Mandy's here, and we have Citi, we have Singtel, we have Samsung, and we have a lot of high-quality investors on our cap table. So what is evidence-based advice? So a lot of times when people think about advisory, they tend to think about when to buy something or what to buy. It's quite transaction-based. So what we believe in is really an evidence-based, liabilities-driven asset allocation. What that means is that you first think about your need first, and then track back on how to meet that need. So for example, if you look at in the middle, core goals, looking at whether you need money near-term, mid-term, long-term, and depending on that, we create a portfolio that meets that need. So a lot of times, people will start with the right first, and then move on to the left, and we think that that process is wrong. You have to think about what your needs are, and then work backward to see how you can actually build that. And one of the main strong points that we have is our relationship with many fund managers, 50 plus, both in the mutual fund side as well as alternatives. As you can see with everyone on this chart and more, we have very strong relationships with many of our partners in very different asset classes. And then what the fee-only business really gives you over long term is really this compounded growth. So as you can see in the illustration on the bottom, a small difference in the fees accumulates to a very big difference over time. So, our name is that we are an endowment for all of us, right? So it's a retirement-focused, very long-term based, evidence-based investing, and we're very focused on getting the right conflict-free solution to you. And so we, service a wide range of clients. In Singapore, we started out with being a digital platform for CPF, which is the MPF equivalent in Hong Kong, and we among our clients are individual investors, but we also have family offices, charitable organizations, and institutional clients that are increasingly coming to us for the platform. And this is a moving chart that I think Greg put in. And it really shows you one of our new features that we have in the app, which is to access our alternatives through the app, but it also shows you how you can see the cost base and the returns in a graphic way. And but for those of you who are familiar with investing in closed-ended drawdown vehicles for private equity, you realize it's actually very difficult to do the performance evaluation because it's over a long period of time, and we have investments in open-ended vehicles. This example is a certain open-ended vehicle that we have in our private equity side, and you can see the cost base with a monthly mark, which is very easy for people to see how your portfolio has performed, just like you would for a public equity or a public mutual fund investment. So we make the process very easy for you to both subscribe and monitor the performance of your alternatives, even in private equity and credit. So, just very quickly, our alternatives, which is the focus for today, we really have a wide range of hedge funds, private equity, private credit, and private real estate products that we curate to onboard. And these are some of the lists of managers that we work with. Obviously, I think we have one of our partners in the audience, Antarctica. We work with Antarctica to offer hedge fund products as well. But the names that you see here, where we work directly to give you access to some of the best-in-class managers. And then, with that, I just want to show you one more page before I hand it over to Chris and Mandy to discuss multi-strat hedge funds, which is, what does hedge funds do to your conventional 60-40 or 50-50 portfolio? And this is a sample example of what it does. And as you can see here, this is, I think, during the last 8 years, an MSCI World would have returned you about 10% annualized return with a 15% vol. Bonds, or the Bloomberg Ag that you see there, would have returned only 1%. With a 4% vol, a combined balanced portfolio would return about 6%, with about a 9% vol. Now, if you add, this multi-strategy here is one of our sample, I guess, multi-strategy portfolios, if you add that, the result is a 1.6% improvement in returns with a 3.8% reduction in volatility. So this is just a sample, right? But it shows you that adding alternatives actually improves the characteristics of your balanced portfolio, and similarly we have examples for private equity and private credit as well. So I think for all of us who are less familiar with the asset class, and I know hedge funds generally have not had the best reputation over the last few years because there's varying degree of different hedge funds that promise one thing and deliver something else. And within that, I think the multi-strat hedge funds have grown in size because they are clearly the sub-asset class within hedge funds that have done the best over the last decade or so. So, but I think overall, there's a reason why alternatives are additive to your portfolio. This is just an example of that. So with that, I just wanted to maybe, give the mic to Chris and Mandy, just maybe to discuss your thoughts. And we're going to keep it pretty interactive, so I'm not going to keep on hoarding the mic. So I'm going to hand it over to Chris to maybe discuss her thoughts on just the multi-strategy hedge fund space in general, maybe the evolution and how it grew, and if you can give some background, that would be very helpful, I think.
Yeah, sure. Listen, just to quickly clarify, I think we would categorize ourselves in the industry that we're really discussing is the multi-strategy, multi-manager kind of asset management business, and we really are what that stands for. We're a group of asset management organizations that invest in a variety of investment strategies across a very diversified set of investment professionals or investment organizations. I think that's ultimately the crux of what we do. Schonfeld, for example, just to kind of paint the picture, we're about a $10 billion firm investing across about 100 plus managers globally across a very diversified set of investment strategies. And I think what that allows us and other multi-strategy, multi-manager hedge funds allow us to do is that we're not beholden to one specific kind of strategy or investment thesis, and we have the ability to dynamically allocate capital across a variety of different strategies based on various market conditions, and ultimately within the various inflection points of a market cycle, have the ability to decide as quickly as we would like, really, from a CIO level down, and a group of, I think, very talented individuals where we think some of the best capital allocation opportunities could be. So that's really, I think, the crux of what we do. The whole intention is to be able to provide our investors, and I think this stands for somewhat universally, but again, I would speak for Schonfeld more specifically, a bit of a low volatility, high return product. That's that's ultimately the end game, but some type of high sharp component to it, obviously. And I think that has become very attractive to investors because inherently the diversification within our portfolio construction is something that the investors themselves aren't always able to achieve by trying to make some of these direct allocations themselves. So I think that's where we fit into kind of portfolio construction. I think there's been a variety of reasons why these multi-manager, multi-strategy hedge funds have been successful in various components that go into that, but maybe I'll stop there, and if Mandy has anything to add, I'm happy to let her add to that.
Yeah, I mean, I think it'd be great if Mandy, you can maybe give us some context around what you're seeing, but also, in your view, why you think this kind of hedge fund space, multi-strategy, multi-manager model has been so successful over the last decade or so.
Sure, thanks. So I think multi-strategy and multi-manager platforms, the definition is slightly different, and we're referring to both, I think, at this point. Of course, Schonfeld is one of the top tier multi-manager platforms. And how we differentiated, I'm sure many of you would be aware, being sophisticated investors. For multi-manager platform, usually there are autonomous risk takers, right? So usually more than 10 on a platform, depending. And it could be, as Chris was saying, across different strategies, different asset classes, right? For a multi-strategy firm, it could be in the sense that it's one CIO It could be the sense that there is no pass-through fees, and the way they allocate capital could be slightly different as well as the way they manage the risk, right? So just to differentiate that very quickly. In terms of these type of managers, actually they have been around for a very long time, right? Just discussing with Chris before, so Schonfeld's been around for more than 20 years, right? So it started off very different versus some of the other ones that you might know, like the Millenniums, like the Balyasnys, some of those that are probably like, that you might be familiar from this platform. So a lot of them have been around for a long time, but in terms of the assets that they manage, among the 4 trillion hedge fund industry, hasn't been as significant as it has grown to today, right? I think today, if we look at recent stats, multi-strategy, multi-manager platform represent about 400 billion of the 4 trillion, so that's very substantial. And it has grown a lot over the past, I would say, 6-7 years for various reasons, right? Of course, the different macro environment where you might want stable returns is one reason why people would gravitate towards these type of managers who have historically been able to demonstrate that they can protect on the downside, they can generate stable returns with lower volatility than, of course, the markets, but also of other hedge fund strategies, right? So that's one of the reasons. But then if we look at investors into the hedge fund industry of 4 trillion plus, right? Who would make up a big proportion of those investors? A lot of them, of course, like a lot of high net worth individuals, family offices, but the institutional investors form a big chunk of that investor universe. And a lot of them, endowments, foundations, sovereign wealth funds, the foundation or bedrock of their hedge fund portfolio many times are built upon this multi-strategy, multi-manager platforms, just because of the quality of returns that they offer. Right? For a lot of these investors like ourselves, hedge fund is one part of your portfolio, so you look into hedge funds as in how it fits into your portfolio construction. Right? What type of returns are you looking for? Because you might have direct investments into equities and bonds, and at the same time you might have privates, right? So in the public arena, if you want a more stable return, then who within all the asset managers out there like can offer you that type of return? So a lot of the institutional investors historically have gravitated towards these managers, I would say. So like institutional investors, I think represent maybe like a little under 2 trillion, right? So that's a big chunk of it right there already. And then I would say the other reason why a lot of investors, including high net worth family offices, wealth platforms that gravitated towards multi-strategy, multi-manager platforms, the quality of returns, right? So in terms of like, what do you mean by quality of returns? A lot of us, we look at risk-adjusted returns. For each unit of risk you take, how much returns are you getting? So I think you look at it from different ratios perspective. Sharp ratio, looking at the volatility of returns, is definitely one metric that a lot of people look at, and we look at these multi-manager platforms, multi-strategy. The big players, meaning the ones above 10 billion, I think, from looking at statistics over the past 5+ years, they have returned more than 2 sharp, right, compared to some of the newer players. And then what other metrics you would look at? The correlation of these managers with the markets in general, and then with other hedge fund managers, right? So other strategies, maybe not multi-strategy, right? So that you would look at that, and then their correlation with other multi-strategy and multi-manager platforms, right? So I think the correlation tends to be low. It's where you want it to be, right? Because you want to have a diversified portfolio at the end of the day. And then apart from that, I think the downside protection as well, right? In terms of stability, right? So that's kind of factored into when you look at the sharp, the volatility of the managers. So those are just a few reasons. I mean, in our seat, we have been talking to a lot of investors, particularly over the past, let's say, 24 months, who have been pivoting into multi-manager platforms, right? And this is a very interesting phenomenon, and expand more upon that later on, but I'm going to pass it back to Chris.
I just wanted to say thanks, Mandy. You helped sell our fun tonight.
No, just leading on that, one of the very interesting phenomenons that I see, and I've met probably 4 of my friends this trip, we're all working at multi-manager, multi-strategy funds as PMs, and clearly you guys have, you guys meaning that industry as a whole has really sucked in a lot of talent on single manager hedge funds. So I guess my question to you, Chris, is do you think that trend continues? Is that sustainable? I mean, I think there's a lot of new players coming in the market as well. Obviously, it's not cheap to hire good talent, and everyone's scouring for the same talent, right? So, what are your thoughts around that?
Yeah, listen, talent is one of the most often talked about pillars of this business, and ultimately the success of your investment talent drives your returns and drives your ability to be successful for your underlying investors. It appears that this trend will continue. It's been exceptionally competitive for a multitude of years, and it seems to have hit a bit of a peak more recently. It's rather challenging, and despite some of those challenges that I think we're all observing, as you rightfully mentioned, I think we're all aware that there are some emerging manager platforms that will be starting rather soon. Bobby Jane, I think, is the most visible one and most public. There's a few others out there as well. We don't need to get into those. So we see that as one of the biggest challenges to our business, to be fair. I think we'll talk about risks, but that's certainly one of the biggest challenges to our business. One of the things that we like to focus on in particular, Schonfeld, because it's easy to gravitate to investment talent, which is super important, but we also like to talk about non-investment talent because you need a platform to support all of these different strategies to investors. So with ourselves, and again, I think all the platforms focus a lot on this, but for ourselves in particular, we've spent an inordinate amount of time and money to build out the technological infrastructure to be able to support a diversified set of strategies and managers. And that's not an easy undertaking. You see a lot of firms that want to go into different strategies and build up different parts of the platform. Some of the businesses that maybe sell-side banks or organizations have been doing for many years, 15 or 20 years, and then they try to kind of port those revenues into a hedge fund, and that's not easy to do, and they want to do it in 12 or 18 months. So hiring, I'd really say identifying, attracting, hiring, retaining the talent, both on the investment and non-investment side, is very, very important. Having people with adequate insight and knowledge of how things actually work. Because I can promise you, and again, having sat 20 years on the bank side, if you don't book your corporate actions correctly, if you don't do your stock splits, if you don't get dividends appropriately paid, that's not just happening for one portfolio manager. You're multiplying that by, in our case, 100 portfolio managers. That's a lot of very unhappy portfolio managers. There's a massive downstream effect. It affects your relationships with your counterparties and your prime brokers. So I think the trend does continue. I think it will continue to be a challenge. We've put a lot of focus on building our infrastructure into the non-investment talent, which is not often spoken about. But I also think that's, potentially led to some of our differentiation and the success that we've had as an operation, as a business over the last many years.
Well, maybe I can share some insights into the conversations we have with investors in terms of these platforms and how to differentiate, and of course talent, as Chris was saying, is one of the main pillars of doing due diligence on a multi-manager platform, right? So just on talent, I think a few things that PMs would look at in terms of, some investors would ask us like how do PMs decide which platforms to go to, right? So of course, the ability to pay, right, from platforms, definitely one that explains why the receptivity to pass through fees is becoming higher and higher. And those that haven't been incorporating that is doing either a hybrid model or just thinking about how to incorporate that. Not easy to convert at all. Culture, right? In terms of do these PMs talk to each other, right? Are they allowed to? And then is it flexible in the firm? Because I think a lot of the bigger 10 billion plus multi-manager platforms have more than 10 to 13 offices globally, right? So that is definitely very attractive for some of these talents for various reasons. And then how they manage the portfolio, right? How ties it to risk limits, right? Do they have to deploy a certain amount of risk, right? If they don't see opportunities, are they forced to deploy, right? So some of those things are some of the questions that like we might have chatted with investors who go very in-depth in conversation. But I mean, as Chris said, like talent, very, very important because that's what a platform is made of. But I think the other thing which Chris would be talking about is of course like the risk management and then like the management team in terms of allocating and whether you have a central book or not, right? So those are various things on maybe the non-investment side to some extent, but the talent acquisition issue we have been having a lot of conversations with investors as well. Because they've been asking.
Great. So before I hand it over to one last question, I think one of the it's two questions. Sorry. One question is around leverage and cost. So I think those are the two questions that we get from our clients in terms of how do we get comfortable with, and risk management is obviously a very, very important part to that. So I mean, either of you, if you can kind of allude to both I think Mandy, you alluded to the cost pass-through, and I don't think some of us may not know what that is. So maybe on the cost side and the leverage side, that would be helpful. And the second question is another question that we get last year in particular when equity markets were strong. Like, oh, this product is good, but then, it's underperforming MSCI equity, right? So, kind of the proper way to look at a hedge fund vis-a-vis kind of equity or bonds, and what is your view? What would be advice to a client in terms of how the proper way to look at a hedge fund or multi-strat, multi-manager hedge funds in particular?
Your first question was leverage and
cost.
And cost.
Cost factor.
Sensitive topic.
You don't have to be specific.
Listen, cost of building these businesses are very expensive. And Mandy had touched on this. A lot of the big multi-manager, multi-strategy hedge funds have cost pass-through models where effectively the end investor consumes a variety of those costs and aggregation of those costs. And ultimately, I think the industry's kind of pitch to a certain extent is that you should be looking at your net returns and not the specificity of the cost itself. And our job is to ultimately create a diversified portfolio of investment opportunities whilst allocating that capital quite dynamically, ideally providing some type of overall product high net returns. And you can debate, and I think every manager will have a different perspective on this. You can debate whether it should be outperforming in certain conditions, underperforming, but ultimately, when you think about the broader risk-adjusted returns as part of portfolio construction, there's a certain validation to that. So that's kind of what I would talk about on the cost side, and certainly Mandy can add her thoughts in terms of what maybe investors think about that. But we've certainly seen an increasing trend, and I guess I'm observing from the inside a little bit, of multi-strategy type hedge funds that want to become more kind of on a cost path-through structure. And ultimately, I think the investors will determine if that's appropriate or not based on the type of business model that those organizations are building. In terms of leverage, I think leverage is a very important part of portfolio construction, and I think it comes down to very individualized risk management across all of your investment teams. So I'd talk maybe a little bit more about risk management and how we think about it and where leverage fits in as part of that. When we are onboarding an investment team or portfolio manager, ultimately the risk management process really starts even before kind of the portfolio construction. We're working very closely with the individual portfolio manager or the investment team to understand their trading style, what's made them maybe perform well in various market conditions, how to think about portfolio construction, how to think about risk and risk mitigation, downside protection, what tools they need to kind of continue to run their strategy effectively, what are the things that we could do once you join Schonfeld to kind of help enhance that process. And I would say at Schonfeld, one of the things that we'd like to suggest that we do well is all of our risk management frameworks for each of the individual portfolio managers and teams are rather bespoke, which has certain challenges in itself. We're not very, what I'd say, industrial in the sense that it's not a one-size-fits-all approach. And we think some of our competitors have maybe a little bit more of an industrial process in terms of how they onboard and potentially off-board managers. We have, I think, a rather patient approach to our investment teams. And I think the reason for that is we don't have as many individual investment teams as some of our competitors. And again, that's done with intent. I think that's an important component to our portfolio construction. And when we identify a team or a portfolio manager that we think is ideally complementary to our current portfolio and ideally also low correlated, and we think that they have a unique investment thesis or unique investment opportunities, we really want to invest in them, in their business, and lean into them. And we also recognize that even really good investors have pockets of drawdowns and pockets of challenges against the markets. That's just the way these markets are very humbling to everybody. You know, whether we have personal or more professional investors in this audience, I'm sure everybody can appreciate that. So by having that, like, I think, overarching approach and being able to work very closely with our portfolio managers, you know, we have a lot of proprietary tools. We can, you know, give them a lot of different things to look at around their portfolio construction and their factor exposures, etc. But having that patience and giving them the assurances that we really buy into them as an investment professional, I think it's a very important part of broader risk management. Again, slightly differentiated for ourselves. In terms of leverage and where that fits in, you know, we really see that more overarching. You know, we have a CIO that ultimately runs our organization, and we have the ability to kind of dial that up or dial that down based on various market conditions. And we also have targeted leverage based on the different investment strategies we have. For Schonfeld, we have 4 primary investment strategies: quant, fundamental, what we call DFI, discretionary macro fixed income, and we have what we call a tactical bucket. And tacticals, broadly anything that's not in those other 3, say it that way. So that could be some type of capital structure arbitrage, M&A businesses, etc. But that's how we think about leverage, and we think it is an important and appropriate tool to utilize, but you have to be adaptive based on the various market conditions and what we think, or what we identify as the right market opportunities.
So I just want to add, I mean, that's kind of how I frame discussions on portfolio construction with our clients, because we offer you know, public equity and public bond type of exposures, and then on top of that we add private equity, credit, and also hedge funds. And the way I kind of, you know, explain our own product in multi-strat and multi-manager hedge fund is what I call levered alpha. And you know, it's actually increasingly, in my view, difficult to generate alpha in markets, and so this structure is a really effective way of kind of incentivizing the best talent out there to come and obviously pay them handsomely, but in return generate alpha. So that's I think it depends on your comfort level in how much allocation you want to have that there, but it is something that is very relevant because it is a high quality way of generating alpha. So that's kind of how I guess present it, and I don't know if that's entirely correct, but so maybe with Mandy, the second part of the question was I think on sorry, what was the second part of the question now?
How do you look at hedge funds and how do you?
Yeah, I mean just the performance and just what would be the right way? I mean, this is a question we get quite often, right? Obviously, when markets are down and you know this is doing well, then people like it. But like markets are up, they're like, oh, why isn't the upside capture like? And it's not supposed to do that, right? So, what is the right way? Do you think we should
There's
understand?
no right way. Everyone have their own like objectives and risk appetite. So I think each to your own. But in terms of hedge fund portfolios, maybe I can talk a bit in terms of some of the family office and high net worth individuals, investors that we talk to in our program. So I think historically, also depending on which stage of family office cycle or whether you're in still building mode or wealth preservation mode, right? So like those are also like objectives in terms of how you look at your overall portfolio. But hedge funds at the end of the day is alpha, right? As he was saying. So a lot of people look at it where you can get like not beta to the markets, but more like generating alpha that you cannot get like somewhere else in just like passive investments, right? So I think in terms of how do you look at hedge funds, we have seen, I'll give you a few examples, right? We've seen a lot of regional family offices, maybe some of the more institutionalized ones. They would be very diversified across all strategies. There are many strategies within hedge fund land, right? Apart from multi-strategy, that's like macro event-driven equity long short, convert up. So like, there's many different strategies. So they would just go through all the universe and just filter by performance and ratios with like risk-adjusted ratios and see which ones they find attractive. Some are very focused on returns. Some are focused on drawdowns, right? They don't want anything more than 10%, right? So those are various angles that you can look at it. And then recently we have some newer family offices or high net worth that have built a lot of their wealth probably from building businesses. And they know a lot about technology or biotech and medical, and wherever they build their businesses, want to continue to invest into those areas. So that's a lot of the beta. They're still in that mindset of like growth, right? But of course, the last 2 years, especially in Asia, it's not been easy, right, to put it mildly. And so a lot of them are pivoting, just trying to find where else can I find returns where like this part of my portfolio is coming down a bit, right? So where can I buffer my overall returns? So, and hence they've been talking to many sophisticated platforms, the wealth advisors, maybe someone like Endowus, and then, so if you look at hedge funds in the public markets, and of course in terms of some of the more stable returns, I think multi-strategy and multi-manager platform have been able to provide a good track record, right? Of course, what you've done before doesn't mean you can do that again in the future, but it's a good example, right? So like I think that's what a lot of investors like. They still have a lot of the growth elements to it, but they do need to pivot a part of their portfolio into something that's giving them more consistent returns, right? So that's one way to build it. And in terms of, okay, let's say like in terms of multi-strategy, multi-manager, there are probably globally about 50 to 60 of them. Not all of them are tier one, like Schonfeld, but like there's like 50 to 60 globally and also some in Asia as well, right? So how do we see investors build it? Typically, of course, they would love to go into the tier ones first, right? So they would say, okay, is there capacity? Are these managers open to additional capital, right? So right now, a lot of them, unfortunately, could be closed or selectively open. So some of them have deployed into one or two via wealth platforms, and then they would diversify. They would diversify into another multi-manager, multi-strategy fund, which would provide different characteristics, right? Before we started this panel, I was also discussing with Chris, like all these multi-manager platforms, multi-strategy, they look similar, right? It seems like they converge in some ways, but all of them are made a little bit differently, right? So I think the first tier has a very broad, diversified mix of different strategies across like equity, macro, quant, RV strategies, versus some of the others. They might be a little bit smaller, maybe a little bit nimbler, but they might have more credit component, right? They might have built their multi-strat fund off like a very strong merger arbitrage sheet, right? Or like some of them are macro manager coming into equities and other asset classes. So you kind of look at them in terms of the returns which these managers are generating and kind of combine them together. So we have seen a lot of investors just doing 1, 2, 3 of these. I mean, like it could be a diversified bucket, but a lot of the times, if you go into them yourself direct, then it will take much more because a lot of them might not take like 1 to 1 million tickets, right? So it might take much more capital to have a diversified bucket of multi-strat, right? So we have seen that among a lot of like the high net worth and family offices recently.
I think what's important for us is to, when we look at a strategy, we need to see whether the fund is doing what it said it would do, right? And I think that's very important. A lot of hedge funds are different as well. Some of them are very long biased, some of them are risk premia. It's very different, right? So I think that's very important. So with that, I'm going to actually turn it over to the floor to see if you could raise your hand if you have a question for our panel. Yes.
I have a very quick question. My name is Tina. I'm also from a hedge fund background. So during the past 2 years, I definitely see a lot of investors turn their interest into multi-strategy hedge fund. So I have a question for Mandy, probably Chris too. That if to summarize the top 3 or top 5 considerations considerations or factors that make an institutional investor that would choose this multi-strategy other than another one? Because a lot of them seems to have very great performance, high Sharpe ratio, low volatility. I don't know. I think just now you mentioned a lot about the talents. Just want to have some more thoughts on that.
Maybe I'll repeat the question
Yeah.
for everyone. So, what are the three considerations for multi-strategy, multi-hedge funds to differentiate themselves? How do institutional investors choose between funds? Is that right?
Okay. So I think the quality of returns would be one of the top because it's more accessible and more visible, right? So they would get the numbers and they will. I mean, a lot of the hedge fund analysts, they would look into the different ratios and see how they stack across in terms of other managers and compare them, right? So in terms of like how consistent are the returns, so like quality of returns, okay, like that's the first one. And then I would say, and because it's also very hard to do due diligence into a lot of these huge like 50, 60 billion, or even like anything above 10 billion is very hard to like, you cannot talk to everyone on the platform, right? So in terms of what they rely on, they would look at the strength of the team, right? So I think a lot of the top tier multi-manager platforms, if you look at the risk team, the bench is very strong in terms of where these people have come from, right? So I think that's a look at the process in terms of how they manage risk, and then like where they've worked before, and then like what is their philosophy in terms of managing risk. And then you would also, in terms of risk management, I think that's very, very important. And then the third differentiating is, I mentioned, I think talent, because without the PMs, definitely that's what makes the cake. So like it's like the PMs is very important. But having said that, I want to add one point, right? Like the beauty of these PMs working on these platforms, they can focus on running the portfolios. So that's why the non-investment team, as Chris was mentioning, is also very, very important for these, right? But like how, in terms of talent acquisition, talent retention, how do they do it, right? So I think those are areas that definitely, if you speak with someone who is client-facing, they should be able to tell you, right? Like in terms of, because a lot of the great talent, a lot of different platforms might be going for the same talent, right? So why would they work for you and not another one, right? And I think those are the three main things that a lot of investors would try to dig deep into. From the manager, or sometimes they would speak with other investors and see, reference checks, right? That's always a good way to do it.
I'll just add a couple quick thoughts on that as well. I would say, kind of expanding on a little bit of what Mandy had mentioned earlier in terms of quality returns. I think what investors are also interested in is the attribution of returns in terms of what region is driving some of those returns and what type of exposures a global asset manager has relative, in Asia and in Europe relative to the U.S. portfolio. And I think, as you touched on, there's a lot of multi-managers have just a very large U.S. presence, and some of their international presence hasn't been as built out. So understanding the attribution of the return, so really, how does that contribute to the diversification of their portfolio? And you touched on this earlier, and I'm very sensitive to this word, by the way, you said culture. And if I can be a little sarcastic, having been in the industry for about 25 years across a multitude, I was in the US, Japan, and Hong Kong. I absolutely believe culture is super important, so that's my starting point. But I also think that's debatably one of the most overused words in the industry. And it's gotten sexy because the regulators want to be sexy. The regulators are forcing that on the industry because there's been a lot of bad actors in this business for a long time. And I think we have to look in the mirror and admit that. And the regulators have felt, and I felt this from my earliest days on the sell side, where effectively you have the regulators walking into the organization, and if there's any regulators out there, there's not a criticism, just to be fair. They literally walk in, first of all, they're saying, we want to make examples of people. We want to impose criminal liability. We're okay putting people in jail, right? They want to put some fear into that. And maybe we don't want to do that, but that's going to be the repercussions of the continued bad actors that exist out there. And we think the way to solve that is through culture. If you create a culture where people feel like they're involved, they're part of something bigger, they feel like part of a team, they're not going to do that because they're going to feel responsible to the people sitting next to them, across from them, around them. And they're going to feel a sense of responsibility. By the way, not necessarily wrong. I believe they're not wrong. But it's imposed in a very kind of heavy-handed way. So culture became an overarching theme. Every bank, every hedge fund wants to talk about culture. The real thing with culture is not what you say, it's what you do. I really believe that. Like my own little Antonelli mantra is, we don't talk culture, we do culture. I think Schonfeld's biggest differentiating point, I'd like to tell you it's our returns, I'd like to tell you it's our investment talent, I'd like to tell you it's a non-investment talent, I'll go down the list. I think if anybody comes in and works in our firm in Asia, and could work at any other firm in Asia, I don't care if it's investment or non-investment, I'd make a bet every single day, and again, I think there's some professionals out there, they're going to walk out a lot more satisfied working at Schonfeld. That's a big statement, by the way. And I'm personally proud of that. And that's my personal legacy, I think, in terms of what I've tried to implement. So I'll stop there, by the way, because I feel like I just give everybody a lecture. And that wasn't the intention. But I think culture is a really important thing, but I think people don't know how to adopt it. And I think sometimes they adopt it for the wrong reasons.
Can I add one point? So in terms of like looking at hedge funds, right? I think like the growth plans of the manager is also quite important, right? In terms of like some of them are already very big. Like if they want to grow bigger, how are they going to deploy, right? Can they still generate the same returns, right? In terms of like there's like the talent, are they grooming it? Are they going for big PMs? So, I mean like not big, but I mean in terms of PMs who have demonstrated they have done it before, and there's only limited supply of those that have done it many years, right? You can always groom new ones. So in terms of growth plans, in terms of where you see yourself, and does that make sense in terms of the returns and the areas that you feel you can deploy capital? So I think that's one area. Thank you.
I was just going to say, because you mentioned culture, Chris, like, I had to put in something about it. That was just but because I've been here for a year, and I think I've never talked about where I work to my friends before. And now I see myself doing that all the time. So it's a very strong culture place. So I think that's very important. And doing is obviously more important than talking about it. So, yeah.
This one's not working. So.
Yeah,
My name is Mandy. I'm also doing asset allocation. Two questions for Chris. One is that I know the market, from our side, we see the market is getting more and more challenging. There's a lot of changes, geopolitics, interest rate cycle, so a lot of things we have to keep updated. But we find that it's definitely more difficult now versus before. Seems that for top tier multi-manager funds, you guys still do very well. So my question is really to understand what I see as the emerging challenges, which are getting more and more difficult to do this every day. And see that we need more focus on. And the second question is really regarding AI. How Schonfeld using AI and try to use AI to further improve your firm in terms of productivity and efficiency.
I'm going to repeat the question again. So the first question is, what are some of the emerging challenges that you see, even for successful multi-manager, multi-strategy hedge funds? Second is, how do you see, or how are you already using Gen AI into your system?
Yeah, thanks for your questions, Daniel. I think both great questions. I think for ourselves, some of the biggest challenges we have and the way we're trying to kind of combat them is markets have been very challenging, various overarching macro factors, and we see sometimes a very discrete amount of factors influencing a very wide amount of outcomes. And it's very difficult to kind of insulate from those things. So what are we doing? We just continue to enhance our risk management tools to ensure that we can identify and try to isolate some of those risk factors or challenges, and we try to do it both quantitatively and qualitatively. And ultimately, by continuing to build a diversified portfolio, a diversified group of kind of investment teams, it helps prevent some of those drawdowns in particular areas of our portfolio itself. I'd say that's the first thing. And I think in terms of the AI piece, probably like
many firms, we have incorporated different aspects of that into our primarily investment side of the business. There are some parts on the non-investment side which, have a lot more work to do, but we're trying to provide various tools to our investment teams just to make their business and their operation more efficient. And some of that stuff is just even the kind of chat GPT type bots where they have the ability to kind of consume some data, consume some research, create some summaries in a more efficient manner, work through kind of some translation schemes, et cetera, et cetera. So, we're using it. I think it's going to be a very important part of most multi-strategy teams' investment processes going forward. I'd say for Schonfeld, there's still a bit of a nascency to it at this point. You're welcome.
I have two questions. One is, as an investor that does not want to look at individual funds, right? Very quickly, can you summarize what is the pros and cons of going to a multi-manager platform like that would be like a million, right? Or a
Or Schonfeld.
I guess Schonfeld will invest in funds, right? Millennium has their own managers, right?
No, Schonfeld is very similar to Millennium.
Okay.
That is a platform that has multi-managers and
And
I'm not doing a good job of selling this tonight, obviously.
versus, I guess, going to a fund of funds. And I think on Endowus you can do both, right?
yes, that's correct.
And then the second question is there a skew towards the investor basis preference in Asia versus the rest of the world? Is it there to big funds? Is there bigger demand relative to the rest of the world for, say, equity long short, StatR, CTA, systematic? Is there any preference versus like big funds versus smaller funds?
You take the second.
Maybe Mandy. But you can take this.
Yeah, of course there are preferences, thanks for asking, and it changes all the time, right? And then because we cover more than 2,000 investors globally, and there are many different investor types, so yes, definitely it changes. But maybe I can give you some color on family offices and high net worth in Asia. So as I mentioned, I think particularly a lot of investors have made good returns and performance from a lot of China-centric managers in 1920. So the indicators have grown very high. And we look at Asia managers universe, and the quantity of China long-short managers is still the highest in terms of the number, right, for various reasons. And then I'd say over the last 18 months, we have seen pivot into various areas, right? For one, people will okay, if I want to invest in Asia, I still like China, but I want to diversify a bit. Where else in China where else in Asia should I look at for exposures, right? So we have seen interest in Pan-Asia long-short, so managers who would do the main markets, right? So think Japan and China being the biggest ones, Korea, Taiwan, Hong Kong, Singapore, and then India, right? So Pan-Asia, we see a lot of interest in that long-short, and then we also see interest in Japan dedicated, right? Some extent India, but not a lot of India long-short funds, right? So that's where we see pivot within Asia, and then towards global, right? So okay, I want to diversify. I've always been in Asia. I mean, last year's markets, global markets done very well. So okay, is there anything we can do globally, right? So they haven't really been doing tech, global tech, because US tech hasn't been doing very well with the growth sectors. So they might look for value investing managers. They may look for managers who are generalists. They invest across many different sectors, right, in the US and global. And then if outside of equity long short, then yes, multi-strategy is one way, and macro, global macro, right? So global macro is a strategy where you see managers look at top down, so rather than bottom up fundamental into companies, they look at the economy, they look at different influences, and in terms of they come up with a few themes where rates are going to be, where ethics going to be, and they put on trades, right? And then usually they do it globally. So that's one area that we have seen a lot of it investors going into, I'd say, in 2022 and then 2023 beginning, right? And then some liquid strategies, CTAs. But those have come and went pretty quickly because the returns haven't been it comes and goes, fluctuates a bit, right? So at the end of the day, that's some of the flows that we're seeing in terms of Asian investors. But the pivot into global diversified multi-strategy has continued, right? And I think a lot of investors have actually deployed into this area in 2020 and 2022 and 2023. I think a lot of them have done it.
Let me take a stab at the first question. I just want to, put in a disclaimer in the beginning, because our audience is not all audited. Verified professional investors. We're not able to talk about specific funds, but just your generic question around kind of fund of fund versus single fund type exposure. You have to understand that multi-strat, multi-manager hedge funds themselves, compared to a single hedge fund, is already quite a diversified, strategy in a way. So it has the characteristics of some fund of funds, right? That's a starting point. But the word fund of fund, I think, doesn't have the best reputation. I think it's because, when you kind of put together a lot of different types of strategies, yes, it may be diversified, but you can also, forego a lot of the returns. And it also has a, double layer fees and, that kind of aspect. So the way we thought about, kind of product within Endowus, within the space, was to, try to bring something that has that diversification in terms of sub-asset classes, but doesn't have, that double layer fee element versus going direct. Versus going not direct, versus accessing the single multi-manager, multi-strat fund, right? So that's the broad. But even for a lot of the larger ones, like Schonfeld, etc., they already have a lot of different types of strategies, so it's already somewhat diversified. But the product that we were thinking was even more diversified in the sense that it's not necessarily biased towards alternative equity or quant or macro and so on and so forth. So we have a lot of requests from clients, not just on hedge funds, but for private equity, private credit, etc., where the general view is that, it sounds good and you seem to know what you're talking about, but I find it really difficult to pick, so why don't you kind of create something for me? So that's kind of your personal preference as well. So it's not easy to say what's better or worse. It's really depending on your own kind of anything
That is well covered here. Thank you.
I was trying to be very generic, but helpful at the same time. So any other questions? Yeah.
Good evening, thanks for sharing. I'm a finance major at the University of Hong Kong. I have two questions about hedge funds. The first question is, what's the biggest advantage you believe hedge funds or quant funds have compared to the majority of fund houses during a bearish market and times of low liquidity? And the second question is, recently some hedge fund managers have faced growing challenges of geopolitical uncertainty because some of those hedging or quant strategies don't work in encountering geopolitical risk. How do you think hedge fund managers can do to navigate those challenges? Thank you.
I think question 2 was how do hedge fund managers navigate some geopolitical risk?
And the first one was on downside protection, or
the biggest advantage we believe hedge funds or quant funds have compared to the majority of fund houses during a bearish market and times of low liquidity.
I'm not sure I can answer that. Actually, I'm not sure exactly. Sorry.
we can give you a. But we can take the second question.
Yeah, geopolitical risk is real, and I think to Daniel's question earlier, I was talking about having a small set of factors driving a wide kind of spectrum of outcomes and results. Geopolitical is certainly one of them that all of our portfolio managers are required to incorporate into their portfolio construction. So, quant strategies might have a particular sensitivity or particular factors associated with that. You have discretionary managers that might take that into consideration as part of like a single stock portfolio construction. Macro managers inevitably are going to be a little more sensitized to that. But I would broadly say geopolitical is just one of the many factors and one of the many attributions around portfolio construction in general and they kind of just have to calibrate that within their portfolio appropriately. And I'm not sure that's going to go away anytime soon. And even as an American, I'm not going to touch the American politics.
Maybe just on liquidity, which you mentioned liquidity, I think, Mandy could add as well, but my own experience is that a lot of the hedge funds that we see are very, very, very mindful of liquidity and, when PMs deploy investments, they're very mindful of what we call average daily trading volume, so you need to make sure that your portfolio can be exited within days, if not a day. So that liquidity part is very, very important. So, and when we talk about liquidity, it's not just the average of the average, right? You have to look at stress periods and so on and so forth, right? So, I think particularly at multi-strat, multi-manager hedge funds, this is a very, very, very important point for them because, again, it's what happens if I have a really strict risk policy, but the competitor doesn't, and we're all like collateral damage when something happens, right? So I'm sure you guys think about that. So yeah, I think these guys are at the forefront of trying to think about that. So yeah, I don't know if I answered the question, but that's.
In terms of the larger quant hedge funds versus asset managers, are those all hedge funds? The comparison that you're making. The first question.
The hedge funds versus other traditional asset managers.
Yeah, it's just the hedge funds in general have more tools to deploy, right? So in some sense, they're less regulated. They can short, they can use derivatives, they can do leverage, they can structure different trades. So that's how they navigate different environments. And then the largest ones, I guess you're meaning by assets, right? So the largest ones, typically, they also have more resources for research and development. So the tools that they can build in-house or the service providers or the external resources that they use, it's just they have more resources to build in terms of managing the risk, looking at different factors like Chris alluded to. It's just the R&D is very important to like the hedge fund and the quant firm.
I can tell you also from my experience being on the sell side, and I'm sure it's even more pronounced now. And a lot of these multi-strat, multi-manager hedge funds are some of the biggest clients, right? And therefore, they have a lot of access, resource, etc. as well, right? So, like Mandy alluded to, they're very well equipped from that perspective, I think. Any other questions? Yes.
I don't have a question. I just want to say something to him.
Okay. Sure.
So basically, hedge funds use AI, machine learning, and deep learning in especially quant researchers, quant developers. And so you're talking about geopolitical things that may affect. Before, even people wake up and go to the hedge fund to work, those technology are working and they got the news and they're deploying. So they know their shit.
Thank you.
Maybe we'll take two more questions and then we'll kind of socialize. So, yeah, go ahead.
First question to you. Given your fintech companies, why consider multi-strategy, hedge fund strategy versus now people are talking about robo-advisory and AI, right? So what's the pros and cons between these two strategies? As I'm by one running a family office, we are also thinking about more passive way or more the active way to deploy to the public market, so in advice or other cryptocurrencies.
Yeah, great. Thank you for the question. So, it's a very relevant question because we actually do get classified as a robo-advisor. I think less so now, but we used to. And what is a robo-advisor? It's basically using, quant or something systematic to do your advice, give your advice, right? I mean, it sounds good, but we're not a robo-advisor because we actually don't do that process. And because if you are a robo-advisor, at least my view is, at best, you're a low-quality quant fund. And we cannot compete with a quant fund, so that's not what we are, and that's not what we subscribe to be, right? So what we are is we have a team of 12 people on our investment team doing very thorough due diligence on each fund, not just on hedge funds, but mutual funds and money market funds, all types of funds. And we try to give holistic advice using that. So it's not about when to buy, what to buy, more to match the liability of the client, right? So yes, we're a fintech company and half of our team is in engineering and product, but the technology has mostly been geared towards building the platform, making it easy, making it cheap, et cetera, right? It wasn't to build signals and find ways to see when to buy, sell, et cetera, right? Which is what systematic funds would do, and they can deploy millions and billions of R&D on their computers and so on, which we can't, right? So that's not what we do. But what we do is we basically leverage the expertise of companies like Schonfeld in hedge funds and in other alternatives, and we make sure that we have the right building blocks for clients to build a portfolio that is relevant for them. So what we strongly believe in is to have a diversified global portfolio and really try to stick to that over the long. So I'll give you an example. A lot of family offices, and I was in a family office too, right? So a lot of particularly family offices in Asia have a bias toward China, right? Naturally. So guess what the China weight of MSCI equity is? It's about 3.5%. Guess how many people are overweight China or have been in the last few years? Why? Because there's a familiarity bias. I know this guy really well. He's really good. Da 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 da. So that's how you kind of put together different really really cool funds, and then you all of a sudden realize you're overweight China and then you're underperforming, right? So the idea is not that China is bad. The idea is that you have to make sure that your portfolio is built over the long run. What you're trying to do, like what is kind of in line with your liability and what we discussed just now. So hedge funds are part of that, but it's not. It's kind of irrelevant to whether we're a fintech company or not. I mean, we also always say that we're a deep tech company, but we're also a deep finance company. And that's, I think, what's the biggest differentiator between us and a lot of the other kind of fintech players out there, because if you look at the investment team, you have people from Only Funds, from Mercer and Cambridge, from like a very, very high quality background of people who actually understand finance. And that's why it's not just a robo-advisor, right? So that's kind of, hopefully that gives you a little bit of color on that. So there was a question for me. I didn't expect a question from you guys. Put me on the spot. Yeah. There's another question in the back. Gentleman in the back.
Well, got two related questions. First one might be a bit stupid because I don't work in investment. So
There's no stupid questions.
So the first question is, are the clients of hedge funds normally less regulated, say high net worth individuals or family offices, as opposed to, say, life insurers who are probably the most regulated in the world? And the second question is, if there are regulated clients, say insurers, do you do anything different to your funds to make it more palatable as an asset class for them? So I'm talking from a risk capital requirement perspective. You need to reserve more in your capital because it's high risk like hedge funds, as opposed to, say, government bonds which are less risky.
I'll touch on that actually. Thank you for your question, by the way. I would say most multi-manager, multi-strategy hedge funds have a variety of share classes dependent on, really derived based on the underlying investor and the investor needs. And ultimately it comes down to the hedge fund themselves to determine how diversified of the share class they want in terms of liquidity terms, in terms of lockups and duration, et cetera, in terms of fees and fee structures, et cetera. So I think that is the largest differentiating point for the investors themselves in terms of how they access the hedge fund. For ourselves, and I would imagine many of the multi-manager, multi-strategy hedge funds, their underlying investors are quite diverse. So So we work with very sophisticated professional investors, institutionally speaking, that can allocate billions of dollars, and we work with kind of wealth platforms like Endowus that ultimately has the ultimate beneficial owner being individuals, which we might not be facing off with those individuals, but we do also have the ability to face off with high net worth individuals or kind of family offices. So it's really a diversity of investors, and again, some of the share classes are created as a result of that. In terms of the capital question, I don't specifically work on the investor side, but I suggest that it'd be highly unlikely that we'd be materially changing something on our investment side specific to that, but I'm always a person that says never say never. But if there's certain, again, kind of capital reserve requirements, it might get married into the share class itself. And I don't know if Mandy, you want to touch on that?
Just the first part, I don't think hedge fund investors are less regulated because in US you have to be a qualified investor. In Singapore, in every jurisdiction, I mean, because hedge funds themselves are less regulated as an investment solution. The investors that invest into hedge funds typically, if they go direct, like I said, like facing a hedge fund director, they would have to meet certain thresholds according to that country's regulatory authorities. But if someone working through platforms, then the wealth platforms would be the entity that's facing the hedge fund, right? So it's on the wealth platform's onus to be a qualified investor, and then it's the high net worth individual's relationship with the wealth platform that is probably less regulated.
Yeah, I would echo that. You reference the insurance policy. I think anyone can buy an insurance policy. Not everyone can buy hedge funds, right? So it's not. I don't think it's more regulated. I think with that, it's already 7:40. I want to leave some time. Maybe last question, but after that, I want to leave some time for networking as well. So maybe individual questions. So maybe last question.
Actually, I've got two. So as far as I know, one of the very critical elements of the hedge fund is the cost of finance. So with the current rate hike, do you see it's an advantage or disadvantage to run a hedge fund? I mean, in terms of your cost of financing, the leverages, and then let's say if now I have cash, I just invest in free cash like bond, I got 5%. So is it easy for me as an investor not doing anything, not taking any risk, to get 5% return or invest in hedge fund? That's the first question. The second question is, as far as I know, especially for multi-manager, multi-strategy hedge fund, usually within the manager themselves they compete. So it's not a collaborative environment. I mean, I'm not sure about Schonfeld, but as far as I know for Millennium, they certainly are, especially competing for inventory for short, competing for the same target asset class, whatever strategy. So from your experience, maybe for Mandy's or for you as well, Chris, do you see a collaborative environment within the fund? Is it good for the fund or not? It's more that's an open-ended question, right? You have other big funds like AHL. I mean, they certainly work in a more collaborative environment because perhaps they have more common funds. That's why they have more engineers, developer, core, they work together. Compared to Millennium, usually they are like side of them. So, thank you.
So I'll start with your second question first. I think the collaboration within an organization starts at the top in terms of what the DNA of the operation, what the kind of philosophy of the operation really the founders, the management team really wants. I think certain organizations are far more clinical, and again, I used the word early, industrial in terms of their process, and ultimately that comes down to how they view managers and how they onboard and offboard managers, and really how they incentivize managers as well. In the end, I think all of these multi-manager, multi-strategy platforms are incentivizing their managers quite quantifiably. It's very formulaic, but we have highly encouraged at Schonfeld a collaborative environment. We think it's important. We think people are the best assets. They have great information. So whether it's quant, and quant can be helpful to discretionary can be helpful to kind of macro. We're not asking people to go and talk about their portfolio and kind of portfolio construction, but where and when people need help, and inevitably, again, as a smaller firm, people know what each other is kind of broadly doing. Our teams are very comfortable kind of getting up, walking on and saying, hey, can you give me a little perspective, maybe a fundamental view on this, because I have a kind of an event situation happening here, I'd love to hear it. So we do promote that, and I think that's again more about the DNA and philosophy of the organization, and I think all firms are slightly different. We find it to be very additive to our overall investment process. Tough to quantify, rather candidly, but I think it certainly creates a differentiated environment. The first question I think is very relevant, basically asking, has the rise in interest rates affected how we think about our portfolio construction, returns? I think you're asking all different shades of that. First and foremost, in a 5% rate, the risk-free rate is very different, so our bar is naturally higher in terms of what we need to return for our investors, and we take that very seriously. There are pros and cons to that. If you're running a business that has largely a low net type construction, meaning longs and shorts kind of an equal size, then inevitably the way you're getting charged for your leverage or getting paid on your short sell proceeds is broadly eliminated within that heightened interest rate environment. That's not really the biggest challenge. But if you have a larger skew to your portfolio, if you have a larger long-only portfolio in particular, all of a sudden the cost of leverage goes up. And that's really down to the individual investment team to think about what their opportunity cost is in our trade. So it changes their investment process and kind of potentially their investment theses around how they want to allocate their capital or allocate their kind of gross market value, whatever their kind of risk limits are, however that's constructed. But the other thing that I'd say the more positive side to it is a lot of our these multi-strategy, multi-manager firms are managing their unencumbered cash quite tightly in terms of how we deploy capital, how we think about leverage as an organization aggregated across all of our investment teams. The value of cash is a lot higher now for ourselves as well. So how we are able to consume leverage based on that aggregate portfolio construction and how we want to invest that cash into either money market funds or into various instruments, we have potentially a different return profile on that unencumbered cash. So that's typically facilitated through our treasury teams. Again, I think all the multi-manager, multi-strategy hedge funds have fairly sophisticated treasury operations. Schonfeld similarly does. We have teams across all parts of the globe. We have individuals focused on pure equities, maybe more fixed income products, more macro products, but in aggregate, our global treasurer is looking at all the proprietary tools and dashboards we have around how we want to allocate or invest that unencumbered cash, which creates a different return stream. So, a few different answers to your question.
I can talk a bit about the investor's perspective in terms of hedge fund performance. So yes, definitely has come up a lot in terms of managers. Like a Japan manager crowd, I would say, like those that are running like standalone funds, market neutral, some of the more low vol strategies, which usual returns are in the mid-high single digits. Yes, they get asked a lot more, right? So what is the added value? But at the end of like those, yes, they get asked a lot of questions these 2 years, right? And then they do have to discuss, like some of the institutional investors, they're looking for long-term stable returns. They want mid-single digits, so they might stick with it, right? So that's one area. For those that might have returned, mid-single digits over the past 2 years with negative returns, and then going forward, investors will look at their long term to see like how they've navigated, why they did that, right? In terms of attribution, which Chris also alluded to earlier, like they will see, like, is this how you do in this market environment? Could you have done better? Is it a structural issue, or like will you have around this performance number going forward, right? So that's 2 scenarios. And then we also hear some managers thinking about putting hurdle rates, right? So they get performance fee above a certain percentage of return, right? It's definitely more common among, I would say, EMEA managers versus the rest of the world. We actually did a survey on this like end of last year across our investor base, across our plan, sorry. And then in terms of those that are thinking of doing it, yes, I think a lot of them are contemplating, but who is going to do it in 2024, actually implementing it? I think more than 80% are not going to do it, but there has been a lot of conversations about it.
I just want to add, this is a question that's not just for hedge funds, right? So, it's not by coincidence that we saw the biggest inflow into money market funds last year, right? Because people were like, why bother with anything else, you know? But I think the question there is how long is it going to last, obviously, and there's a lot of clients who have a hard time differentiating between yield and total returns, right? So you see a yield number on a money market fund, and you compare that to a yield number on a bond, and you're like, oh, why would I buy a bond? You know, but then you realize once things change and the tenure goes down or what have you, the total return will be higher in a bond and so on, right? And equity for sure, and then hedge funds over time. So I think when you just look at a snapshot of when money market funds are giving you 4%, 5%, etc., it doesn't sound as interesting, but then things quickly change, right? So I think that's the important thing to realize when you look at investments as well. So with that, I need to show you our QR code. It's a before January 28th, you're going to get another $300 off of our already low commissions. But again, I mean, the real idea is that we are conflict-free. We are really trying to give you institutional access to individual investors in an endowment type way. So I know we're relatively new in Hong Kong. We're much more established in Singapore, but we really want to build a presence in Hong Kong and through these events as well with esteemed guests as well. So I really want to thank all of you for being here today. Please stay around for drinks and networking. And thanks again for Chris and Mandy for a very insightful session. Thank you very much.
Thanks, Hugh.
I'll keep it up there for a minute.